Have you ever found yourself wondering, what's the smartest way to get a car? Should you pay in full and own it outright? Should you finance and make monthly payments? Or is leasing a better option, allowing you to drive a new car every few years? This debate plays out everywhere, from finance forums to family gatherings. Some argue that paying cash is the best move because you completely own the car, avoiding interest and monthly payments. Others swear by leasing, enjoying lower monthly costs and the excitement of driving a new vehicle every few years. But which option actually makes the most sense? Car dealerships push financing and leasing deals, but are they really the best choice financially? What about depreciation, maintenance, and insurance? In this video, we'll break down the 4 main ways to get a car. We'll compare the total costs over 3 years, consider the hidden expenses, and even explore the psychology behind these decisions. By the end, you will have a clear understanding of which option is best for you. Part 1. The 4 ways to get a car. 1. Buying outright, paying in full with cash. If you have enough money saved, buying a car with cash can be the easiest and most straightforward option. Instead of making monthly payments or dealing with interest, you simply pay the full price upfront and drive away with complete ownership. It's a one-time transaction with no strings attached. Imagine you want to buy a Toyota Camry that costs $30,000. If you have the money, you can walk into the dealership, pay the full amount, and the car is yours instantly. You don't have to worry about banks, loans, or monthly bills. Just sign the papers and take your new car home. Pros of buying outright. No monthly payments. No interest charges. Full ownership from day one. Cons of buying outright. You need a lot of cash saved up. Instead of investing or saving, your cash is locked into the car. Depreciation. Cars lose value over time, so you may not get back what you paid. Let's say you decide to sell the car after 3 years, and its value has dropped to $16,000. That means the total cost of ownership, what you spent minus what you got back, is $14,000. Even though the car lost value, this method still turns out to be one of the most cost-effective ways to own a vehicle in the long run. 2. Financing. Hire purchase. If you don't have enough cash to buy a car outright, financing, also called hire purchase or HP, is a popular way to spread out the cost over time. Instead of paying the full price at once, you pay a deposit upfront and then make monthly payments with interest until the loan is fully paid off. Once you complete all the payments, the car is officially yours. Let's say you want to buy a Toyota Camry that costs $30,000. With hire purchase, you might need to pay a 15% deposit, which will be $4,500. The remaining $25,500 is financed with an 11% interest rate over 3 years. This means you'll be making monthly payments of around $800 for the next 36 months. By the time you finish paying, you will have spent $34,000 in total, $4,000 more than if you had bought the car outright. However, the good news is that after 3 years, the car is completely yours with no more payments left. Pros of financing. No need for a huge upfront payment. You don't need to save up thousands of dollars to get a car. Easier on your budget. Instead of spending all your money at once, you can spread the costs over time. You own the car at the end. Cons of financing. Because of interest, you end up paying more than the car's actual price. Monthly commitment. You must make payments every month, which can strain your budget. If you miss payments, the lender can take back the car. Now, let's look at the total cost of ownership. If, after 3 years, you decide to sell the car for $16,000, your net cost of ownership will be $18,000, since you paid $34,000 in total. That's $4,000 more than if you had bought the car outright. However, this method makes it easier for people to afford a car by breaking the cost into smaller, manageable payments. 3. Leasing, long-term rental. If you like driving a new car every few years and don't want to deal with ownership, leasing might be a good option. Leasing is similar to renting a car for a set period, usually between 2 to 4 years. Instead of buying the car, you pay monthly to use it, and when the lease ends, you return the car to the dealership. You never own it, but you also don't have to worry about things like resale value or depreciation. Let's say you want to drive a Toyota Camry that costs $30,000. You decide to lease it for 3 years. The dealer asks for a $4,500 upfront payment, and your monthly lease payment is $350. This is much lower than if you were financing the car. Over 3 years, you will spend $16,500 in total on lease payments. Once your lease term ends, you return the car and can choose to lease a newer model or explore other options. Pros of leasing. Lower monthly payments. Always drive a newer car. You can upgrade to a new model every few years. No worries about depreciation. You don't have to sell the car later or deal with its lower resale value. Most lease cars are under warranty, so repairs may be covered. Cons of leasing. You never own the car. Mileage limits. Most leases have a yearly mileage limit, e.g., 12,000 miles per year. If you go over, you'll have to pay extra. Fees for wear and tear. If the car is damaged beyond normal use, you might have to pay penalties when returning it. Unlike buying, where payments eventually stop, leasing means you'll always have a car payment if you keep leasing. 4. Personal contract purchase, PCP, a mix of financing and leasing. Personal contract purchase, PCP, is a popular way to get a car because it combines elements of both financing and leasing. It allows you to drive a car with lower monthly payments than traditional financing, but you don't fully own the car unless you make a large final payment at the end of the contract. This option gives you more flexibility, as you can return the car, buy it, or trade it in when the contract ends. However, depending on your choice, it might end up being one of the most expensive ways to get a car. Let's say you want a Toyota Camry that costs $30,000. With a PCP deal, you first pay a deposit of $4,500. The finance company estimates that, after 3 years, the car will still be worth $15,000. This amount is called the Guaranteed Future Value, GFV. Now, instead of financing the full $30,000, you only finance the difference, which is $10,500, the car's price minus the GFV. This is then spread over 3 years with an 11% interest rate, making your monthly payments around $450. At the end of 3 years, you have 3 choices. 1. Return the car. 2. Buy the car. 3. Trade it in for a new car. Pros of PCP. Since you're only financing part of the car's value, your payments are smaller. If you love changing cars every few years, PCP makes it easy. Cons of PCP. If you keep the car, you'll likely pay more than if you had just financed it. Large final payment. To own the car, you need to make a big balloon payment. Just like leasing, you might have to pay extra if you go over your mileage limit or return the car with too much wear and tear. Part 2. Which option is the cheapest? Looking purely at cost, buying outright is the most affordable option over time, with a total cost of $14,000 after resale. Leasing comes next at $16,500, making it a solid option for those who want a lower monthly payment and don't mind not owning the car. Financing through hire purchase costs $18,000, making it more expensive than leasing if you plan to sell the car after 3 years. However, if you plan to keep it long-term, it's still a better deal than PCP. PCP is often the worst financial decision if you choose to keep the car, as it costs $36,000, far more than financing or buying outright. If you plan to return the car, it costs $21,000, making it the most expensive short-term option as well. Which option is best for you? Want the lowest overall cost? Then buy outright if you can afford it. Want the lowest monthly payments? Then lease a car. Plan to keep the car for years, then finance hire purchase. Like switching cars often? Choose PCP or leasing. Your choice depends on your financial situation, lifestyle, and long-term plans. Which option would you pick? Let me know your thoughts. Don't forget to hit the like button and subscribe.